All right, so today we'll get back to our discussion about forward and futures contracts. So remember, this is our first introduction to what are called derivative securities. And I mentioned last time that derivatives are a special class of financial securities that where what the point of them is that they give you the right or the ability to make a transaction in the future at a price that's determined today. So derivative securities um, provide right or obligation to buy or sell an asset, depending on what it is, what kind of asset it is, what kind of derivative it is, rather, to buy or sell an asset in the future at a predetermined price. Okay. Now, the reason why they're called derivative securities is because their value depends on, or you could say is derived from, the value of the underlying asset that you now have the right or the ability to control in the future. Okay, so the basic types that we'll be looking at here, and there's more than just the ones I'm showing you, but these are the most important ones, I would say. Forward contracts, futures contracts, and options. There's a few others too, which we may get to later on, but these are the ones we want to make sure that we cover. And so the purpose of these derivative securities is to hedge risk. Okay, that's really what they're intended for. Of course, the word hedge means reduce or eliminate risk. So in other words, if you're doing business, let's say in a foreign country, and you are constantly being exposed to foreign exchange risk, there's a derivative out there somewhere that will help you manage this risk. Or if you're buying gold or whatever it is, there one of these derivatives will be there and will be available to you to either reduce uncertainty of the future price of an asset or maybe the delivery of a future asset. But the whole point of these is that they allow us to eliminate or at least reduce the amount of risk that we're exposed to. Now, having said that, derivatives can be used for speculative purposes, which means gambling, of course, where you're doing exactly the opposite. This means taking on risk with the hope of earning profits as a result. And we'll see some examples of each as we go along. So you can either reduce your risk or you can increase your risk. Now, if you do that, though, the great thing about derivatives is that they can magnify your returns, but also your losses quite considerably. So that's one of the things that makes them so attractive. If you're a real gambler, I mean, this is the way to go. I mean, derivatives are the gambler's dream. It may be possible to set up a position where, let's say, if the price of gold goes up 10%, your profit goes up by 100%. But if it goes down by 10%, your profit, of course, goes down by 100%. So it's possible to leverage your position in the underlying asset into a much riskier position where you'll really make a lot of money if you're if you're right, and really get clobbered if you're wrong. So in this section, we're specifically looking at forward and futures contracts. We usually discuss them together because they're very similar to each other. Forward contracts and futures contracts are structured in the same way, but there are several important institutional differences between them. And that would help you determine which one would make the most sense, whether you're hedging or speculating. Usually one of them would be more convenient than the other. Okay, so there's several key differences between the two. All right. So we started to look at last time forward contracts. And basically, it's an agreement between two counterparties, as they're called, in which one is going to buy an asset in the future and one will sell the prices agreed to today. Okay, so let's say quickly, For example, a corporation can enter into a gold forward position or contract, or actually what I should do is call it a forward contract on gold, in which the corporation agrees to buy 100 ounces at 3,500 per ounce, let's say on September 1st. The counterparty to the contract is probably an investment bank or a commercial bank, possibly, let's just say a financial institution that will agree to deliver the gold on September 1st for the same price, of course. So we agree, we sign a contract, which the corporation agreed to buy the gold for $3,500 an ounce on September 1st, and the other side of the contract agrees to sell it to me for $3,500 an ounce on September 1st. So why is the corporation doing this? The corporation may be in a position where it is going to buy gold in the spot market, it's called, on September 1st, and is concerned that the price will rise above $3,500 by that time. So the great thing about this contract is that it means that no matter how high the price of gold actually goes, they're going to pay $3,500 an ounce. End of story. The only drawback is that if the price goes down, they can't save any money because they're committed to paying the $3,500 an ounce. Okay, so you're locking yourself into this position. On the other hand, the corporation may decide, hey, we know the gold market very well. We're really sure that gold will go up. So the corporation may also speculate on the future price of gold by entering into the same position. And if the price rises, the corporation will make money. Otherwise, of course, they'll lose money. So in other words, it may be that they don't really want the gold at all. They just want to speculate on the future price of gold. So the price goes up, they'll make money this way. Otherwise, they'll lose money. Okay. So the buyer in a forward position like this is said to have a long forward position. And the seller is said to have a short forward position. Now, if you are in a position to sell gold, suppose there is another corporation that will need to sell gold on September 1st and is worried that the price will fall by that time. The corporation can hedge this risk by entering into a short forward position by agreeing, let's say, to sell for $3,500 an ounce. On September 1st. So see, the beauty of this is that it guarantees a minimum price. Well, it guarantees a price of $3,500 an ounce. The problem here is that if the price goes up, we don't get to take advantage of that. We're locked into 3,500. But on the other hand, if the price goes down, we still get our 3,500. So that would be the reason why you would want to do this. But again, the corporation may also want to speculate that the price of gold will fall by September 1st. And so what they'll do is enter into this contract, and if they're right, they will make money. The short forward position will profit from a falling gold price but will lose, of course, um, from a rising gold price. Okay. Again, you can use these contracts to either hedge or speculate, but the common thread here is that a long forward position is used to do one of two things. Um, Lock in the price at which gold can be purchased, or speculate on the price of gold rise. Of course, you can imagine the short position does the opposite. The short forward position is used to lock in the price at which gold can be sold, but it can also speculate on the price of gold falling. So it's an awfully convenient arrangement, especially because there really aren't any costs involved. There might be some fees involved, I guess, but you're not actually buying or selling this contract. You're not paying for the right to do this. You're just agreeing with somebody else. Yeah, let's do this. Let's get together and I'll buy and you sell, or vice versa. So now one of the good things about this is that the forward contract can be customized in any way to the needs of the counterparties. In other words, the buyer or the seller, it doesn't matter, can choose any asset they want. They can choose any date they want, and they can choose any quantity of the asset to be delivered. So the counterparties can agree the asset to be delivered, date on which the delivery will take place, and the quantity of the asset to be delivered. Now, the price is a separate issue. This is not something that we actually agree to, right? I'll show you in a bit where the price comes from. That's not something that we just shake hands and say the price is this. I mean, normally that's not how it's done. There's a very specific mathematical relationship that holds between the price in the market now and the forward price, or the price at which this asset will be delivered. So as far as terminology goes, um, the current or market price of an asset is known as the spot price. And the price for future delivery through a forward contract is known as the forward price with a specified maturity date. In other words, there can be many different forward prices. There could be a 3-month forward price, there could be a 6-month forward price, depending on when we take delivery of the asset. Okay, now here is the relationship. By the way, I do want to mention here that the forward price of an asset depends on spot price, the time until delivery, the risk-free, which we'll discuss in the second, rate of interest, and whether or not the underlying asset provides any income to the owner. Okay, in other words, if you have an asset where you're earning cash flows of some kind, it makes a big difference compared to another asset where you're not receiving any kind of income. So, for example, if the asset is the British pound, you could put those British pounds into a British bank account and earn the British rate of interest. But if it's gold or silver or whatever, other precious metals, you're not going to get any income by holding it. So that will affect the forward price, depending on which asset you've chosen. Now, this is the actual formula for an asset that does not provide any income to the owner. The relationship between the spot price and the forward price is, and this is it right here, as you can see. All right. Now, of course, it should be self-explanatory what these letters refer to, but let me just go through them again. F is the forward price. S is the spot price. Now we all know E is approximately 2.71828, et cetera, et cetera. It is the limit, as you remember, from calculus. Okay, that's one of the ways we can define it. And so it's approximately 2.71828. You see it all the time. In a course like this, derivatives modeling often is based on what we call continuously compounded interest rates. So let me just briefly mention that. R is the risk-free rate of interest, which means that it's the yield on a treasury bill or treasury security, whatever it happens to be, with maturity T. And T itself is the number of years in the future. So normally that would be less than a year. So it's going to be a fraction of a year. So 6 months would be like 0.5, let's say. So risk-free is the yield on treasury security with maturity T. And there's a very good reason why we're using the risk-free rate. And you'll see in a second what this is all about. But in derivatives modeling, we always use the risk-free rate of interest. There's no risk premium, let's say, because the results can be proven to hold with certainty, which means there's no risk involved. And then let's see, are we missing something? Nope, we got them all. All right, so there's our E. And E to the RT is used. If I multiply that by some amount of money, or you could just think of this as the future value of a dollar received at time T when interest rates are compounded continuously, it's called. Now, what does that mean? Well, all right, here's how it works with compounding. Interest rates can be compounded using many different conventions. For example, if a bank pays a 4% rate of interest with annual compounding, an investment of $1,000 will be worth. And so in 1 year, oh, I forgot to mention that. An investment of $1,000 for 1 year will be worth by the way, with a timeline like this, 0 means today. This is meant to be the time. This would be a year in the future. Okay. And it would be a simple matter of taking your original $1,000 and multiplying it by 1 plus the rate of interest. And so you end up at the end of the year with 1,040. Now, if the bank is compounding semi-annually, that means they're paying you half the interest but twice a year. So what would happen is after 6 months, we'd have 1,000 times, not 1.04, but 1.02. And then at the end of the year, we're multiplying not 1,000, but 1,020 times 1.02. So you're going to have more than 1,040. Hold on, let me get out my calculator here. We get the exact amount. So this is semi-annual means twice a year. And so that's going to be 1040.40. So there's an extra 40 cents worth of interest. Okay. And then, of course, if I keep changing this, every time the compounding frequency increases, the future value of the sum, as it's called, continues to grow. Now, of course, we don't want to draw a timeline every time we change the compounding frequency. So we're going to show you an example or a formula you can use to do this directly. It's a fairly common textbook formula. Actually, we don't need the one here. So what's happening here is that n, the only thing that's new here, well, there's two things new. A is the future value of the sum. N is the number of compounding periods per year. All right, so what we could do is take that last example and see what happens with quarterly compounding without having to draw the whole thing out. With quarterly compounding, which of course means 4 times a year, you're paying 1% 4 times a year. You'll have A equals 1,000, 1 plus 0.04 over 4. And whatever this number is, it'll be slightly higher than the previous example. The question is how much higher? And it turns out to be 1,040 point, let's say 604. Okay. So every time I increase the compounding frequency, so does the future value of the sum. Okay. Because the interest builds on itself more rapidly. That's really the bottom line. Now, in practice, we tend to see this compounding take place on a daily basis. Banks in particular, like if you go to a commercial bank or a savings bank and put your money in a savings account, with almost without fail, it's going to be daily compounding. Or if you look at your credit card statement, you'll see that that's exactly what they're doing. And you know, when you first get your card and you get this enormous thick packet of legal documents, somewhere in there they have to mention all this. Now, imagine that we keep increasing the compounding frequency. And so what's going to happen here is this. The limit as n goes to infinity, in this case, happens to be e to the RT. So A equals then e to the RT. So in this case, that would be and so e to the 4.04 power is about here we go. 1.0408. So therefore you're going to wind up with 1040.81. Okay, so in other words, compared to quarterly, it went up roughly another 20 cents. Okay, now this last case has its own special name. This is what we mean by continuous compounding. And the other examples when n is finite, compounding is said to be discrete. All right. So you may have had the chance to take a course called either discrete math or finite math. It just means that you're dealing with finite sets instead of infinite sets like you do in calculus. It's really more for computer science applications. So when you have that limiting case and it goes to infinity, this is what we mean by continuous compounding. But for anything short of that, we call it discrete compounding. So often we see continuous compounding used in derivatives models in particular. Not that this is happening in the real world, but it's a lot more convenient. And so it turns out that we can take any assumption and turn it into another assumption if we need to. So in other words, what I could do is if the bank isn't really compounding continuously, what we can do is take the discrete time version and convert it into a continuous form or vice versa. But Hull's book in particular, he loves continuous compounding. He uses it all the time, even when it's not really appropriate. He has a tendency to get carried away. But well, you'll see what I mean as we go along. He just loves it, but there's some very, very nice, helpful properties of continuously compounded rates that you just don't get with discrete compounding. That's the reason for that. So now, by the way, this is the future value, which means I start with a certain amount of money now and it will be worth X dollars in the future. Usually our motivation here will not to be calculating future values, but what's called the present value, where we just take this whole thing and work it backwards. So if I add this negative exponent here, suddenly this becomes the present value of a dollar. Okay, so let me show you a quick example of this. Suppose that a bank pays 4% with continuous compounding. An investor wants to deposit a sum of money today that will be sufficient to ensure that he has $1,000 in the bank, let's say in 2 years. How much must he deposit today? And this is just another way of saying, what is the present value of $1,000 received in 2 years when the rate is 4% compounded continuously? So it's going to work like this. Instead of calling it A, we'll call it P. Remember, A before was the future value, P is the present value. A is the future value, so therefore we have 1,000 e to the minus 0.04. This time it's 2 years, so we need all right, and so let's see what that turns out to be. Whoops, that's okay. I made a typo. So, oh wait, whoops. No, yes, that's right. 923 11 as 12, let's say. So what this means is that if the investor deposits 923 today in this bank, you will have $1,000 in 2 years guaranteed. And so this sum that I've just created here, this is the present value of $1,000. when the rate is 4% compounded continuously. All right. Now, the reason why I brought that up is because that's what we're going to see most often in these models, but not always. Sometimes we are calculating future values, but often it's present values that we're interested in. And like I said, Hull's book and many other derivatives modeling books love to use continuous compounding because it does have some really nice features. And in fact, discretely compounded rates actually introduce some biases into the calculation of rates of return over long periods of time. But we'll have this discussion some other time. For now, we'll just note that we're going to use continuous compounding instead of discrete compounding, at least for these models. Okay. Now, with all that background, you can see that this model tells us very simply, the forward price is nothing but the future value of the spot price. That's interesting. That's all it is, huh? Yes. Now, this is called a no arbitrage relationship. Now, this is where we're getting into some extremely deep waters. Um, this, write this down for me one more time. Um, the asset pays no income. This is referred to as a no arbitrage relationship. So now that raises an interesting question. What exactly is arbitrage? Okay. So in other words, the fact that it's called a no arbitrage relationship means that F, whatever F is, it's the only price at which we do not have an arbitrage opportunity here. So arbitrage is a process in which risk-free profits can be earned by doing two things simultaneously: buying an underpriced asset, selling an overpriced asset. And not only that, but what's even more interesting about this is that we're usually using borrowed money to do this. So we end up putting money in our pocket without taking any risks. That's what arbitrage means. Okay. Now I'd like to start you with a very, very simple example of this, just so you get a feel for what arbitrage really means. And then we'll move on to this one. Suppose that the exchange rate between the dollar and the pound is, let's say, $1.30 per pound. That's about right. Gold currently sells for, let's say, $3,500 in New York. Say there's a gold dealer in New York who will sell it to you for $3,500. And let's say that would, you can also turn around and buy it in London for 2,500 pounds. All right, so there's two dealers, one in New York who's asking 3,500, the other dealer in London, 2,500 pounds. Now, here's the interesting part. The price in London, after adjusting for the exchange rate, is 2,500 pounds times $1.30 per pound. And that works out to be 32.50. Well, how can that be? Shouldn't it be the same in both markets? The answer is yes. So here's the thing. Gold is relatively underpriced in London and relatively overpriced in New York. So a trader will do the following: buy gold in London and sell in New York. Now, of course, we're assuming that it's possible to do this. Okay. But remember, these are traders. They should be able to take any positions in these markets earn a risk-free profit of 250 per ounce. And again, if you're using borrowed money, this is a sweet deal. You're not putting up any money, and yet you somehow put profits in your pocket. Now, this won't last forever, as you can imagine. Um, Also, by the way, there are going to be transactions costs here, which will eat into your profits, but not $250. I don't think it would cost that much to ship gold overseas. It doesn't sound, well, I probably shouldn't say that. I don't know how much it costs, but an ounce of gold is very light. It probably doesn't cost that much. There's probably insurance, but let's say that it only costs $50. So your actual profit is 200, but that's still pretty sweet because you didn't put up any of your own money, you didn't take any risks. Um, now, based on supply and demand, what's going to happen here is as this process continues, you can imagine what's going to happen. The price of gold will rise in London because people are buying the gold there. The price of gold will, of course, fall in New York because we're selling it there. We're dumping a lot of gold into the New York market until the price is equal again in the two markets. So it doesn't last forever. Now, in practice, this kind of thing doesn't happen very often at this point in time, as you can probably guess. Markets are extremely efficient, and a lot of trading is done by computers. But even then, practice, this is unlikely to arise in the real world. The situation, if it does, it won't last for very long. But here's what actually happens. Um, you've got, let's say, hedge funds where they take a lot of risks. Instead, what will happen is a hedge fund can buy enormously powerful computers. And this is same is true for any financial institution um, to continuously monitor financial markets, looking for temporary discrepancies in pricing between markets, and then using a huge amount of borrowed money, jump in and take advantage of any temporary mispricings, even if they only last a fraction of a second. Just the whole thing is it's like it used to be like in the 70s, let's say, all this trading was done over the telephone and you didn't have computers like we do now. Yeah, they were there, but they were very slow. You didn't have the internet, it was very different. And so this kind of thing could occasionally pop up. Now it's like gotten to the point where human beings can't really react fast enough to take advantage of it. So if you see your computer notices there's for a tenth of a second, there's a discrepancy in the two markets, it should just about have time to jump in and buy and sell and make some money for the hedge fund. But even then, the differences could be so trivial that you're not going to make any real money unless you borrow your brains out to finance this position in order to leverage it to something that's worth your while. Like imagine if they notice the price of gold is 1 penny different in the two markets. Well, that raises the question, well, is it worth our while? But if you use $100,000 or $1 million of borrowed money, that starts to make a big difference. And so at this point in time, arbitrage often takes place through these types of transactions where computers are being programmed to jump in and look for these opportunities without human beings even getting involved because it's just too fast now. But it's the fact that this can happen that causes market prices to remain aligned properly with each other. It's almost like the way gravity holds together everything in physics. Everything is attached to the earth because of gravity. Here, the relationship between financial prices is maintained by the fact that if they're not, then arbitrage will take place and push them back to where they belong. It's almost like If you ever notice these new cars have certain AI features, and if you're driving along, let's say, and you get just a little too close to the shoulder, the car will either warn you, or in some cases, it'll grab the steering wheel and push you back where you belong. So I would compare arbitrage with the car nudging you back to the highway, not onto the shoulder. So that's what's happening here. Now, then what we can do is take other more complex cases and show how arbitrage would result if a particular pricing model is violated in practice. So the gold one is easy. Most of these are much more complicated than that. They involve several transactions to exploit and time. So that means it's going to be harder to do this, but not impossible. So with this one here, for example, um, we want to know, well, if this relationship fails to hold, how would we make money from that? Okay. So it's a good question. So if F is above SE to the RT, then that means this side of the equation is too low, which means we buy whatever's on this side and we sell whatever's on this side. The question is, how do we do that? So here we could borrow S dollars and by the way, we're going to make some heroic assumptions here. We're going to assume that it's possible to both buy and sell at these market prices. We're also going to assume that we can borrow and lend at the risk-free rate of interest. It's if you're a very high-rated institution, you're a trader for a very well-rated investment bank, you're getting in close, but it's never going to be exactly the same. So we'll take this with a little grain of salt, but F greater than SERT means we're going to borrow S, which means, by the way, we're paying in the future, this is how much we'll repay, SE to the RT, because this is the future value. We buy the asset, we take a short forward position, which means we agree to sell it at time T. So in other words, you're borrowing S dollars, we buy the asset with the understanding that at time T, we will need to repay in our loan SE to the RT. But at the same time, though, we're agreeing to sell this for F. Now, F, remember, is the artificially overvalued forward price. So we're given an opportunity to sell this S for a price that's too high to be consistent with this formula. So once T arrives, we deliver the asset through the contract as we agreed. We collect F dollars. Then we have to pay back the loan plus interest, which is SE to the RT. But we already agreed that F is greater than SE to the RT. And therefore, by assumption, this number is our profit will be, which by assumption is positive. So again, we're being allowed to buy something that's a little too cheap, sell something that's a little too expensive. We put the difference in our pockets with no risk to ourselves because we'll have no net position in the future. All right, and that's what we mean by an arbitrage profit. This should never happen in an efficient market, by the way. Okay, but everyone's keeping their eyes on this. So just in case there is an opportunity, they're going to grab it. If it's the other way around, F is too low, we're going to short sell the spot asset. Now, short selling is a tricky thing that we can do. This is something you can, even in this day and age, you can do this with stocks. It is possible to short sell a stock. Now, of course, this requires you to have an incredibly good relationship with your broker. You have to have wonderful credit. You have to put a collateral. There's transactions involved, costs involved. But what this involves is this. An investor does the following: borrows shares of stock from a broker, promises to return them at some point in the future, probably within a week or so. Then sells them in the market and then later repurchases them in the market at a hopefully lower price, and then returns the shares to the broker. So it's not impossible to do this, but it's very awkward. A lot of expenses, a lot, let's just say it's not the most straightforward thing in the world, but if it can be done, then that means that we can go ahead. And by the way, until derivatives came along, this is really the only way you could bet on a stock price going down. Now derivatives make it easy to bet on stock prices going down. This is kind of an awkward, but if we're assuming that this is possible, we're going to short sell. The right hand side is too high. We're going to sell whatever's on this side. The left, the F is too low. We're going to buy whatever that is. So we'll short sell the S, collect the S dollars, lend that out at the risk-free rate. Remember, we said before, we're assuming that it's possible for us to borrow and lend at the risk-free rate, enter into a forward position to buy the asset at price F. And then when the contract matures, we use our contract to acquire the asset, which we've already sold, return it to the broker, and collect our interest. So in other words, we end up with SC to the RT after paying F for the stock. And by assumption again, it means our proceeds are SC to the RT minus F, which by assumption is positive. Okay. So that means that if this leads to an arbitrage, F is too high, F is too low, leads to an arbitrage opportunity. That means the only price at which there's no arbitrage opportunities is this one, F equals SC to the RT. If they're not equal to each other in either of the other two cases, there's arbitrage opportunities. And when they are exploited, they'll force this relationship to hold again, right? The prices will adjust until this relationship holds. So think of it, sometimes this is called the implied forward price. Again, it's taken from our knowledge of the spot price, risk-free rate, and time. That's all we need to know. Okay. Wow. Now that's a lot to think about. But all derivative securities are based on this notion of no arbitrage relationships. They're all priced in the exact same way. Now, what about the case where the asset does provide some kind of a cash flow to the owner? Like I mentioned before, the British pound. Now, what we're going to do here to keep things simple is we're going to assume that no income from the asset this is the relationship. If there is, we're going to make another heroic assumption here. Q is the rate at which we earn that income, and Q is continuously compounded. Okay, so that's how we adjust the formula when there is some kind of income paid to the owner, but it has to be continuously compounded, meaning that for all practical purposes, it's being paid out on a regular basis. It's not something you receive every so often, like the dividend on a stock, which is only every quarter. So this is the one you see the most often because many assets out there do provide some kind of income. So here's an example. By the way, once you enter into this contract, the price that you've agreed to buy or sell is often referred to as the delivery price because that's the number that's actually locked into place. Tomorrow, F could be different than it is today. it depends on what happens as a result of the passage of time or fluctuations in S or fluctuations in R. So um, delivery price is the forward price on the day that the contract was entered into. All right. So when you first enter into this contract, the forward price is the delivery price. But then after that, afterwards, the delivery price is fixed, but the forward price can fluctuate in the market. Now, I think Hall's book uses the letter X to represent the delivery price. All right. So that being the case, if the price of the asset can fluctuate, the forward contract itself can have a positive or negative value. So on the day on which the contract is entered into, um, the value of the contract is zero to both counterparties. That's done by design. They choose a price at which we're both in the same position. After first day, the value of the contract will fluctuate. Now that's assuming that the asset price changes so that gains of one counterparty exactly match the losses of the other. So it's like a zero-sum game where the gains of one match the losses of the other. Their net position is zero between the two of them. So here, if you're long, the value of the contract looks like this. This is if you had the right ability to sell this contract to somebody else, which is not normally the case, but it's not unthinkable. This is the value on forward position. And if F has risen since the contract was entered into, then of course F will be positive. Otherwise, it'll be negative. Okay. Um, for the short, it looks like this. Of course, it's reversed. If F has fallen since the contract was entered into, then F is positive. Well, you can see they can't both be positive and they can't both be negative. And in fact, if you add those two together, you'll see you'll get zero, which is how it should be. All right, so this is an important detail. There's a difference between the forward price, which is the price at which the asset is being delivered, and the actual value of the contract. That's what this is. So F, let's just make a big note here. F is the forward price. X is the delivered price. That's where you're actually going to take. If you do take control of the asset, then you're going to pay X dollars for it. And finally, F is the value of the forward contract, which could be zero. All right, now. Oh, here they're just proving why this is happening. All right. Anyway, let's start with an example here. We have a 6-month forward contract. So T is a half. Six months. Keep it simple. The delivery price is 11.20 per ounce. So the contract was entered into. We both agreed that the delivery, the gold, wait a minute, what is this asset? Oh, it doesn't even say what the asset is. Whatever it is, let's say it's platinum then. Um, oh, and it's, yeah, per ounce. That's the delivery price. No matter what happens, that's the delivery price. A month later, the forward price has risen to 11.30 per ounce. 11.30. The risk-free rate is 5%. And now they want to know what is the value of the position to the long and short. In other words, the buyer and the person who agreed to buy is, remember, the long position. The person who agreed to sell is the short position. Now they could both be zero, but since the price in the market is, wait a minute, I think I made a typo here. Yes. Since the forward price is different from the original delivery price, that means somebody made money and somebody lost money. So the question is, which is which? All right, so the long position looks like this. We'll put a little reminder here. This is the long position. So F equals 1130 minus 1120. E and the exponent is 0.05 times 0.5. All right, let's see what that's going to be. So 0.05 times 5, of course, is 0.25 or a quarter of a year. Oops. I've got 1284. The short position is this one. And you can see it's just the negative of this one. 1120 minus 1130. And then we have e to the 0.05 times 5. Oh, wait a minute. Oh, this is 0.5. My mistake. Sorry. 0.5 years, not 5 years. Oh my God. That was bad. Let me fix this one. So that exponent is actually only 0.025. That makes a lot more sense. And when you multiply that by 10, 1025 I have. Does that look right? Oh, you know what we forgot about? A month has gone by. Uh, that's a tricky part of this. All right, instead of 0.5, it's a month later. You see right there, 1 month later. I didn't pick that up. So it's 5 months. So 1 month later, look how tricky that was. T is now not 6 out of 12, but 5 out of 12. All right, so this 0.5 will be replaced with whatever that is. So this is a little bit off. Um, oh, hold on. Oh, you know what else is? Oh my God, it was so small I couldn't even see it. This is this is negative. That's the other thing. Um, I literally couldn't see this negative sign. It was so tiny. And so I left it off of here, and that's not helping things. Let me put in that negative. Yeah, that was rather important, right? All right, now finally we can get this right. Negative 0.05. Now we're talking $9.79. So the holder of the long position is now has made a profit of 9.79 because the gold or whatever this asset is went up $10. The short, you're only reversing the F and the X. This is different. The rest of it is the same. All right, well, you don't have to do anything because you know that it's just negative 979. Okay, great. So if, let's say, for example, the two sides got together and said, we don't really need to make this transaction. Let's close out these positions. The holder of the long position would expect a payment of 979 from the holder of the short position because you don't just say that's it, let's end this contract when I'm up 979. It's like imagine you're playing a game of chess and somebody says let's just, you're way ahead and they say let's call it a draw. No, it doesn't work that way. You're up 979. If they want to close out the contract, they're going to have to pay you 979 because that's what this is worth. All right, so that's how what these numbers are telling me. So now, of course, when you enter into a contract for hedging purposes, you may not be interested in this part. It isn't really that relevant because when it expires, you know that you're going to be able to buy or sell the asset for the price you chose. But if you're a speculator, this might make a great deal of difference to your position. Okay. So now hedging, as we mentioned earlier, um, is designed to eliminate risk. So now the numbers you're seeing here are quite outdated. The pound used to be a lot more expensive. What you're seeing here is a series of exchange rates between the dollar and the pound. The spot price, meaning the price at which you can buy the pound today, is 206.83 per pound. If you can wait a month to take delivery, that goes down to 206.62. 3 months forward, 206.22. And then finally, 6 months forward is 205.53. So if you want to enter into a forward contract, this is the price that will be determine how much you'll pay when you buy the British pound. It's not as easy to find. I had to make these up because you don't see these in the newspapers very often anymore. But as we've already seen, um, these prices are designed so that you know how much it costs you to enter into a forward contract. Now, with currencies, it can get a little confusing because there's two currencies involved, of course. So just a quick review here. If the spot exchange rate is, oh my God, it does that every so often. So here we go. Let's say the exchange rate, we'll call it S. And then you look in the Wall Street Journal the next day and you see it's going up to $1.60 per pound. All right. So what that means then is that it now takes $4 to buy a pound. This means that the dollar is weaker and the pound is stronger. All right, because it takes more dollars to buy that same pound, that means the dollar must have weakened, the pound has strengthened. We say that the dollar has depreciated and the pound has appreciated. Now, if for some reason, if let's say a corporation wants to hedge the risk of a weaker dollar, meaning a higher price, then he or she can hedge this risk with a long forward position. Okay. Because then you are locking the price at which you can buy. And if it goes any higher than that, you can just use your contract to buy the asset, in this case, the British pound. Um, if the corporation wants to hedge the risk of a stronger dollar, which means it goes down, and he or she, oh, what am I saying? He or she? In this case, it would be it. The corporation is not either he or she. It can hedge this risk. Um, it can hedge this risk with a short flow position. So in other words, with a hedge, a long means you're betting against the price or trying to protect yourself from the price going up. Short means going down. But in this particular case, we have this extra terminology to deal with. So up means the dollar has depreciated, and down means the dollar has appreciated. And so I, as the investor or hedger, or whatever the case may be, can lock in prices for delivery at different points in the future. Now, if you go back to this formula that we had back here, this one, F equals SC to the RQ minus Q power. Now, again, I did mention before that holding a foreign currency or a foreign currency earns interest denominated in foreign rate of interest. So I hold British pounds, I can earn the British pound rate of interest. Therefore, the British pound is an asset that provides an income to the owner. Therefore, the forward price of the pound needs to incorporate Q, the continuously compounded term, to the British pound, meaning the British rate of interest. So we'll use this model. So the way we interpret that is that the R in this case, this is the spot exchange rate, dollars per pound. T is, of course, time in years. R is the US risk-free rate. And of course, because we're using E in here, that means it's understood that this is continuously compounded. Q is there for the UK or British risk-free equivalent. It's also understood to be continuously compounded. Okay, so this is the model we use to calculate the forward exchange rate between the two currencies. So if you look here, though, if you notice, as we look further into the future, the forward exchange rate is actually dropping. So that means that if F is less than S, The only way that can be is if R is less than Q, so that R minus Q is negative. So in other words, when it goes down like that, that implies that the British rate of interest is higher than the US rate and vice versa. That's all it means. All right, so now futures contracts are coming up next, and they are very similar, as I said, to forward contracts. There's a handful of institutional details that we need to know about. For example, I mean, we still have the long and short positions. Now, these contracts are not, well, let's take a step back. So futures contracts compared to forward contracts. Now, forward contracts are negotiated directly between counterparties. In what we call the over-the-counter market, or sometimes the OTC market. So in other words, they're private agreements. These are not then going to be, it's not normally possible to buy or sell forward contracts to outside parties. So once you enter into a forward contract, it's essentially a binding agreement. That's it. You can't say, well, I'm just going to sell this contract to somebody else. You can't do that. It's a private agreement. But not so with futures contracts. Futures contracts are only traded through organized exchanges, they're called. Now, you might be thinking the New York Stock Exchange. No, it has to be a specialized derivatives exchange, such as the Chicago Mercantile Exchange, the biggest derivatives exchange in the country. Now, by the way, if you're interested in learning more about this, CME as it's called, if you look at their website, which is CME Group, oh boy, do they have a lot of useful information here. Let me just put this in here. And so first over here, let's look at where they have products available to us. It's a long, long list of futures, and also we'll see later on options on all these different assets: agriculture, cryptocurrencies, energy, equity indexes like the S&P 500, foreign exchange, interest rates, metals, you name it, it's here somewhere. And even more excitingly, over here under the education tab, they have all these courses and lessons that you can take for free and learn a lot more about these products. And not only that, but you can take exams to prove that you passed these, and you can even get some kind of certification from the CME that you've taken all these classes and passed them. So if you're really interested in this material, this is on the table. You can just look at these classes. You can take them. They're free, by the way, just completely free. You just take the ones you want, pass them, and you have proof that you now know more about this stuff. And at some point, you'll get certificates for these courses that you've completed. It might look really good on your resume. Okay, so there's tons of them. And look how long this got. There's so many of these. Now, some of these are very specialized. You might not be that interested, but a lot of these are extremely important. So yeah, what are Bitcoin futures? You probably didn't know that, but Bitcoin can be purchased through futures contracts, which means that they're even more heavily leveraged than they already are. The price of the Bitcoin futures can rise even more dramatically than Bitcoin itself. but it can also fall more dramatically than Bitcoin itself. So we want to keep an eye on that. All right. So now what's good about this trading on the exchange, one advantage of trading on an exchange is that contracts, the performance of the contracts is guaranteed by the exchange and the story. Forward contracts expose the counterparties to credit risk, right? Because what else is going to happen? If you enter into a contract with an organization that goes out of business, you're not going to get the cash flows you were promised. Okay. So the futures contracts are free of credit risk. Now, here's another beauty of that. We have this thing called offset. Um, and so what that means is you just take the opposite position in the same contract and your position is wiped out. Okay. So for example, if a corporation enters into a long futures position on gold or December delivery, the position can be offset or unwound by taking a short futures position on gold for December delivery. It's as simple as that. So you still have the two contracts, but they're offsetting each other. So therefore, your net position is zero. Um, Unfortunately, this is not normally possible with forward contracts, meaning that you're stuck with what you have. So it gives you this opportunity to get out. Now, because of this, studies have shown that while nearly all forward contracts ultimately result in delivery of the underlying asset, with futures contracts, the percentage that result in delivery is as low as 2%. Whereas most people who use futures contracts, they're not really planning on taking or making delivery. They're just trying to hedge their risks without actually getting involved with buying and selling the asset. So in other words, they're more flexible in that way. Now, here's where it gets interesting. With a futures contract, the investor is required to put deposit funds into an account known as a margin account. And that's just to protect the exchange. Like if you're losing money and you can't pay it, they have to cover it. So they want to make sure that your losses are limited to this margin account. So the margin account is a form of collateral. It represents a small percentage of the total value of the contract. For example, let's say, suppose that a British pound futures contract is written on 62,500 pounds, which means you're controlling the exchange rate at the moment is about $1.30. If you were to go out and buy that many pounds, it would be about $81,250. The value of these pounds is approximately 81,250. The margin requirement could be, let's say, 3 or 4 thousand. It's some very small amount of money. So once the investor has deposited these funds into a margin account, each day the value of the position is recalculated. Um, if the investor made money, the profits will be credited to this account. And in fact, you can take out the difference. If there's some minimum amount you always have to keep in there, but if you're above that, you can just take it. Okay. On the other hand, if the investor lost money, the losses be subtracted from the margin. The balance in the margin account falls below a specified level. Maintenance margin. Then the investor will be required to put more funds into the account. They won't just let it go to zero or negative. Okay. So this is known as a margin call. And the additional funds are known as maintenance margin. I'm sorry, variation margin. Maintenance is how much you have to keep in there. Variation margin is how much you have to put back into the account. And if you don't, they'll just close out your position. Now, this part, and by the way, this process is known as marking to market. Okay, that's one of the big differences with the forward contracts. You don't get any of this. There is no market market with a forward contract. So this nuisance is avoided altogether. And oh, okay. I guess those are the most important differences. Now, it turns out over time, if you're to draw a plot of the evolution of the spot and forward futures prices, not the forward prices, the futures prices. Oh, by the way, one more thing I want to mention here. The marking to market requirement usually the forward price of an asset and the futures price are slightly different, right? They're not guaranteed to be the same every day. So the plot here is this is the dollar amount in time. Let's say that this is my futures price. This is my spot price. You see what's happening is they're getting closer and closer to each other. And on the final day of trading, they have to equal each other. All right. So, all right, let me relabel this. They can fluctuate around, but at the end they have to equal each other. And then if they start out in the opposite direction, let's say this is S and this is F. Either way, they have to converge to each other on the maturity date. If not, well, guess what? That means there's going to be arbitrage opportunities. Like if F is above S on that final day, here's how you can make money. Take a short position in the futures contract, meaning you're offering to sell the asset at price F. Buy the asset in the spot market at S, and then use that asset to deliver through the futures contract. Collect the difference, which is F minus S, which is positive. If F is below S, well, then of course it's the other way around. What you're going to do now, and by the way, just be aware, as long as you remember, buy what's underpriced and sell what's over, you'll always make money. Okay. Now hedging, just like forward contracts, can be done. A long hedge means you're buying the asset, short means you're selling. So the long, you're basically protecting yourself from a rising price, or you're speculating on a rising price. Here's, for example, U.S. importer needs to buy 100,000 pounds in 6 months. The thing he worries about is a weaker dollar, because that means each pound that he's earning will not bring him as many dollars. So he doesn't want the exchange rate to go up. So he takes a long futures position, which means that the exchange rate does go up, which is what he's worried about. He'll at least make a profit from his futures contract that offsets his losses in the spot market. The short hedge is just the opposite. He's agreeing to sell because he either expects the price to drop and wants to make a speculative profit, or he would lose money if the price goes down, and he wants to collect some income from his futures contract to make up for those losses. All right, so here's the exporter who needs to sell 100,000 pounds in 6 months. He doesn't want the price to drop because he'll get fewer dollars for his pounds. So instead, he enters into a short futures position to lock in the price at which he can deliver them. All right, and then again, just a quick wrap up of the differences between forwards and futures. Forward contracts are negotiated between counterparties. Futures are traded on organized exchanges. Since a forward contract is negotiated with a counterparty, there's always a risk of default. Okay, that's not true with the futures contract where they're guaranteed. Futures contracts can be offset with an opposite position, which is not normally possible with the forward contract. And for no marking to market with forward contracts, but there is with futures. Okay. So anyway, that seems to be the end of this section. What comes after this is by far the most complicated of all the derivative securities, which is options. This is the one we're going to spend probably the rest of the course with because they're so complicated, and our focus will be more than anything else on understanding how they're priced in the marketplace. These are relatively simple contracts we've been looking at here, but as you'll see with options, the complexity comes in the fact that you're entering into a contract in effect, but you have the right to change your mind. So that's what really makes them so much more difficult to analyze, but also much more powerful and flexible. So we'll save that discussion until next time.